Welcome to Under the Basswood Tree with Basswood Counsel, a podcast where we bring you brief, valuable conversations and insights to help you navigate the complex world of business transactions. From cross-border deals to international tax structuring, we cover topics across all industries. Our team and colleagues will share their insights and provide practical tips on key issues for you and your business. Let's get started.
I'm Chris Klug. I'm here with Gine Lee, and this podcast can focus on what we call coming to America. It's really looking at non-U.S. companies that are looking to bring some kind of U.S. operations or start a company in the U.S. to continue their business to the U.S. market. Gine is going to help out by, she's not going to pretend to be a president of a non-U.S. company, but she's going to ask some questions, and we're going to have a dialogue about what are the tax implications of a company outside the U.S. coming to the U.S. and how it should be structured, what are some pitfalls, and, it'll get into, how to finance operations in the U.S., debt versus equity. So then with that, Gina?
Yeah, so, if I were a president in another country, first thing that would come to my mind would be, so how should I operate in the U.S. as a foreign corporation, or should I form a separate legal entity in the U.S.? What are the key considerations that I should keep in mind?
Yeah, so the starting point really is what kind of footprint the company is going to have in the U.S. So they're merely just selling goods, and they're not going to be manufacturing or producing anything in the U.S., and their local presence isn't necessary. Perhaps having a broker in the U.S., maybe get their goods into stores is enough, because perhaps you avoid the nexus for U.S. income tax to apply directly to the operations of the business. Once you pass a threshold called having income effectively connected to a U.S. trade or business, then that sets that foreign corporation being subject to U.S. income tax. And at that point, that can bring some negative implications if you don't have a U.S. sub. So it's really looking at what are you doing. Is a branch office sufficient in the U.S., meaning you don't really have a separate legal entity, because you're not going to have the effectively connected income, which we refer to as ECI. If you're doing business with another company to get into the U.S., maybe you form a joint venture in the U.S. But again, what type of entity? Should it be a partnership for tax purposes, a corporation? These are key considerations. Or if you think your business can thrive in the U.S., maybe you set up a separate corporation in the U.S. So starting point is really what is the footprint and what is the long-term vision of the business? And sometimes it flows from, all right, let's first see if it works. So maybe we start for broker trying to get our, whatever our goods are into stores, or whether, it really depends. Is it a service-based business? But from a tax standpoint, when you're thinking through this, you want to think about the optimal tax structuring. And that's going to depend not only looking at the U.S. tax implications, but the home country tax implications. So you can't just look at this in a vacuum. And, on the U.S. side, we have the federal, state, and local income taxes. So it can get complicated. Then it is, is it just cash coming into the U.S., or are you transferring intangibles or other assets into the U.S.? And then you got to look at, will there be a tax on that transfer out of the home country to get it into the U.S.? And then, you want to be working closely on both sides, so you know whether there's tax planning opportunities. What happens way too often is our clients come to us after they've been here for 3 years and like, what should we do? And you look at it, you're like, oh, you should have done things way differently. So planning ahead of time is always key.
But after a certain number of years, are there still ways to fix it?
You could fix it going forward, yes. Yeah, so it really depends on structuring. So maybe that is getting that U.S. sub-company underneath the parent home country. What we'll get into is something called the branch profits tax, which can be unfavorable to a foreign company that has effectively connected income into the U.S. And by forming a sub-company, you kind of separate U.S. operations from the non-U.S. operations, thereby hopefully not having leakage where the same income is being taxed in multiple jurisdictions. But from a key straight, from the get-go, you kind of want to think full circle. So you want to think about what are the tax implications today? What are the tax implications to get things started? Formation. What happens? How are operations being taxed? And you want to think about it all the way to, all right, now we got profits in the U.S. How do we get that back to the parent foreign company to then give the profits to the shareholders? What's the most tax efficient way? And so there's, and that comes into right at the beginning, debt versus equity. So you just got to think about everything. And then, another good part about having a sub company in the U.S. that's U.S. based is the foreign company is not going to want to be subject to U.S. payroll taxes or employment type taxes. It's a liability they're not going to want. So again, separate that off.
Yeah, so you talked about effectively connected income. Can you tell us a little bit about it? It can be a little bit daunting for someone who's not familiar with the U.S. taxation.
A non-U.S. person or a non-U.S. company, and here we're calling it foreign company, they're subject to U.S. tax on two items. First one is income that's effectively connected to a U.S. trade or business. And that tax is based on a net amount, so income minus expenses. And then if it's a foreign corporation, it's going to be taxed at 21% at the state level. At the federal level. You also have to consider the state income tax implications. And then the second type is more passive income, what we call fixed or determinable annual or periodic income, what's referred to as FDAP. This is more passive, so dividends, interest, it could be capital gains, other types of income. Usually that's withheld by source by the person paying the income.
Yeah, so I take it that if I have a foreign corporation and have U.S. source income, I'll only be taxed on the U.S. source income. Is that right?
So it gets hard to tell what's U.S. source. Once you have U.S. source income, that gives the U.S. the right to tax the income of the company. If you don't form a sub underneath the foreign company, which is a good reason to form a sub, what's the definition of U.S. source? They might try to expand that. So what the home country says, no, that's our income. The U.S. is saying, no, that falls within the effectively connected income, so we're going to tax it here as well. And so it's best to avoid that. But and so there is some crossover. There can be some crossover once you reach that threshold of having the effectively connected income. So it's very important to plan for this because you don't want to have that leakage where you got income being taxed in multiple jurisdictions and neither one allowing a foreign tax credit.
Got it. So you mentioned that effectively connected income will be taxed at 21% and FDAP at 30%.
It can be, yes, yeah. And so you would want to avoid that. Obviously, if you have income tax at 21%, you would prefer 21% over 30%, right?
Right. And what about branch profits tax? Is that something that's imposed at a flat rate, or is that like a different type of tax imposed by the U.S.?
Yeah, so branch profits tax, and let me explain what that is. So the idea, the concern and the reason for creating the branch profit tax rules is that a foreign corporation could do business in the U.S., have ECI, and only be subject to that 21% tax rate. And then they can get the money tax-free out of the U.S., but for a rule, because it's, right, if it's a branch, it's a pass-through entity. So there's no entity-level tax. So, i.e., there would be no dividend out. And so when you don't have that U.S. sub underneath the foreign parent, the rule is if you have effectively connected income, you're now subject to the branch profits tax. It's supposed to mirror what a dividend tax would be, but it doesn't. And it's based on a reduction of U.S. assets, not actual distributions. U.S.-based assets could be reduced for a number of reasons. If there's that reduction, it's a deemed dividend, presuming there's earnings and profits. So the way the branch profits tax works is, yes, there'd be the income tax at 21%. And then there'd be this deemed dividend that would be taxed at 30%. And so that fixes the problem of, a foreign company being able to do operations in the U.S. with one level of tax, because all U.S. corporations have two levels of tax. So it fixes that problem. But the branch profits tax is less certain of when it's going to apply than the dividend. So it's easier and better for planning usually to have a U.S. sub company underneath the foreign parent.
So when it comes to effectively connected income, what are included in such what's considered effectively connected income? Is it just the operational income, and what's included in that operational income?
Yeah, so it'd be operational. What you should look at it, and like I said, it's hard to expand it, but there's no exact definition of what a U.S. trade or business is in the code. And so it's regular continuous operations in the U.S. What you try to do is kind of act like there was an entity, and like these income and expenses applied to that income, to what we're saying is this U.S. trade or business. But since there's not an actual entity, you don't have it laid out, it gets difficult to isolate it as if you had a U.S. sub-company underneath. So what's included, it would be, are you doing services in the U.S.? Do you have a store in the U.S.? What are you selling in the U.S.? Do you have a warehouse? And so once you meet the ECI, the effectively connected income test, then it's trying to define what that income and the expenses associated with that make up the business are.
Okay, so I think it'll be easier to determine if I'm, for example, selling goods into the U.S., right? And then if I earn certain amounts of revenues, then that will be potentially subject to U.S. tax.
That is correct. So if you can look at selling goods, and then, selling goods into the U.S. itself doesn't make effectively connected income, like for example, that broker example. But once you have operations where you're going to set up a separate business, then you get into the effectively connected income and, should you form the sub or not. But yeah. So selling goods into the U.S. or having people coming over here and doing services.
Right.
Physically on U.S. land and doing services, that's pretty straightforward that you have effectively connected income. You can look at the treaties. Sometimes they can exempt certain number of days depending on what they're doing. But yeah, it's important to know when you trip the effectively connected income.
So does it get any trickier if I'm performing services, but then, we're in the global world, we perform a lot of services online. So if a customer calls, we talk to them over the phone from outside the U.S. We log into their computer, and then we try to fix whatever issue they might be having. Everything is online. And what if they really don't have a presence in the U.S. other than maybe like some dependent agents picking up goods or doing some kind of repair services? Maybe?
Okay. Well, you mentioned a couple terms I don't understand. You said online and computers. What are those? All right. Joking aside. Yes. So doing services in other countries are going to be sourced to those other countries. So that's not going to create ECI. But you mentioned dependent agents. If you have dependent agents, those are more like employees because they only work for that company. That usually will create ECI. So it depends on what they're doing, depends on their authority to execute contracts in the U.S. Independent agents who maybe they're brokering for 5 or 6, 15, 20 companies to get goods sold in the U.S., that typically does not fall into the effectively connected income.
Yeah, so I think we want to also talk about the FDAP income that you briefly mentioned. So what are some examples that are included in FDAP?
Yeah, I mean, the most relevant ones to a parent foreign corp and U.S. sub corp would be transactions between the two. So for non-U.S. people, they're subject, they can be taxed favorably in the U.S. as compared to U.S. people. So capital gains, for the most part, not subject to tax in the U.S. Interest income, as long as it qualifies for what's called the portfolio exemption, not subject to U.S. tax. And then, tax from dividends from U.S. corp. So if you had a U.S. sub, you'd fall into that U.S. corp where the dividend would be subject to tax. If you have interest income, there's a 10% rule where the portfolio exemption does not apply if 10% or more of the U.S. company is owned by the foreign parent. And so, yeah, you're not going to get the portfolio exemption, but then you look to the income tax treaty with that country. And if there's an income tax treaty, usually that would exempt interest income from the U.S., and so you get that same benefit. But if there is with FDAP income, dividends from the U.S. corp, for example, you look at the treaties to see what the tax rate, by default, it'd be 30%. If there's an applicable treaty, then it'd get reduced, sometimes even 0, but 5, 10, or whatever the tax might be. The U.S. subcorp is responsible as the withholding agent to withhold that tax.
So if I'm thinking of forming a U.S. company, so is that a taxable event or is it tax-free? Because, basically what I'm trying to do is form a company in the U.S., put some cash in from the parent company. And also, I think you mentioned, I also want to have some kind of a loan and also have some equity provided by the shareholder. So like in this interplay of different financing options, what are the tax implications from the U.S. tax standpoint?
Yeah, so perfect example. So the typical U.S. corporate rules apply to a non-U.S. person contributing assets into the U.S. So as long as you got the 80% control group, a transfer of assets into the U.S. subcorp would be tax-free. But maybe you want to trigger tax, and maybe you can trigger their tax before it becomes U.S. tax. And maybe it's only triggered for U.S. tax purposes, but not the home country purposes. And kind of what this, if you have appreciated assets, you're going to contribute into the company, that can give you a higher basis, meaning when you sell it, you recognize less gain. Moving on to how to finance the operations, equity versus debt. There's some key considerations. So on the equity side, to repatriate back to the U.S., you're looking at a dividend. So you're going to have that, tax in the U.S. and whatever the dividend rate is to that company. Then if you use debt, the interest income can be a deduction if there's a treaty to the U.S. company. Well, it can be a deduction either way to the U.S. company, possibly not be subject to tax to the foreign company in the U.S. And there's some other, the repayment of principal on that debt would not be taxed in the U.S. So that's a way to get some more money out. You also have to look at the home country and see how that's taxed there. So a lot of countries would tax that interest income that's being paid up to the foreign parent corporation, whereas a lot of other countries, they have what's called a dividend equivalent exemption or participation exemption, meaning a dividend paid from a foreign sub to the U.S. parent or to the foreign parent in that country would not be subject to tax. So you kind of have to look through all the rules, kind of find what's the most optimal, what fits the best for the circumstances. And what I would say is there's a lot to think through. We kind of started and we thought through the beginning parts. Part 2 of this will move into some tax incentives that apply, tax implications of repatriation of profits. We'll look a little bit at state and income tax. And of course, if you have any questions, please contact us. I want to thank Gina for working with me on this episode, and I thank you for watching our podcast.
We hope you enjoyed this episode. To stay up to date with the latest legal insights and Basswood events, please follow us on our Basswood Counsel LinkedIn page and visit our website at www.basswoodcounsel.com. Thanks for tuning in, and we'll speak to you next time.